Thank you very much for the invitation to speak here. It's a huge pleasure for me to have this opportunity, also because it's my first time in Korea, and I have to say I learned a lot from being here and listening to you and to looking around a bit in Seoul. I like the introduction from Joshua about myself, because it's very funny. If you work like me in a research department of a policy institution, then if you're introduced by an academic, you're described as a practitioner. If you're introduced by a policymaker, you're described as an academic. So you really don't know anymore where you're at home. But let me tell you, I have two homes. So one is more academic and one is more policy. So my presentation is about systemic risk and macro-prudential supervision. Keep in mind that this type of presentation is a very short version of things that I designed for policymakers to provide them with frameworks how to think about macro-prudential supervision. And as it is my style, much of the things I have to say is very much inspired and structured by research, both my own research since about 20 years and and research by many other people, some of which are in the room here. I should, however, say that all what I have to say are my own views and should not be regarded as the views of the European Central Bank, the Eurosystem, or the European system of central banks. So, okay. If you think about macro-prudential supervision, the basic underlying phenomenon and concept that we have to think about and mind about and design our policies about is systemic risk. The relevance of it has been doubted by people before this crisis and has been made extremely clear by this crisis. I don't need to illustrate this type of statement. Now, policymakers find it useful to start with a definition of a complex phenomena like systemic risk. I offer you here a very short version that we published recently in the Financial Stability Review of the ECB. Systemic risk can be defined as the risk that financial instability becomes so widespread that it impairs the functioning of a financial system to the point where economic growth and welfare suffer materially. So if you want to put systemic risk in one sentence, we find it expedient to use such a definition. Of course, there are many other definitions. There is no unique one, so you can use different definitions. But we find this one expedient. An important aspect of systemic risk is that it involves all components. It can involve all the components of the financial system: the intermediaries, the markets, and the market infrastructures. Is there a problem?
The translators are hard to.
Oh, okay, I'm sorry for that. And this type of feature, that systemic risks are actually affected by all components of the financial system, will have a very important impact on how we design macro-prudential policies. Moreover, making the problem even more complex, we have to keep in mind the two-way relationship between the economy at large. And if we think about the economic models and concepts we have, we face huge challenges here to integrate actually a horizontal view on the financial system, in particular from a financial stability perspective, and fully capturing the two-way relationship with the macroeconomy at large. So this is why I'm mentioning that. Let's have a look, just to get an illustration, at one little gadget that we have developed in the ECB. We call this the KISS. KISS stands for Composite Indicator of Systemic Stress. It's a very simple indicator to illustrate, to track systemic risk. It's not an early warning indicator. It's a coincident indicator of the current level of systemic stress in a financial system, here the euro area system. And I would like to just highlight, if you look at this indicator, which varies between 0 and 1, that you see really that if you take the last 10 years, that the only truly systemic event of that decade was the present economic and financial crisis. So the indicator in the fall of 2008 almost reaches its maximum level of 1 at that time. What does that mean? This indicator is composed of 5 components, covering the money market, the bond market, the equity market, foreign exchange, and intermediaries, a novel feature of this indicator. So we capture actually the instability of a wide range of intermediaries in the indicator. And each of these components actually has submeasures relating to volatilities, downward price trends, credit spreads, even up to recourse to marginal lending facilities of central banks by the intermediaries. Now, these type of ingredients are normalized between 0 and 1 through specific techniques I don't have the time to go into, and they're aggregated across these 5 dimensions by capturing the dependence between these 5 components. And so this dependence is the second novel feature of this indicator. So basically, the indicator is particularly high when there's extreme stress in all these 5 components together and not in isolated parts of the financial system. And this is why it's a systemic indicator, so which we call KISS. And you see that actually the events of 2007 to the present way dwarf events like related to the unraveling of the dot-com bubble, the accounting problems, the September 2001 events. Nothing came even close in terms of the degree of systemic stress as the current episode. And this actually indicator tries to capture the different elements of systemic stress horizontally across the financial system, although it doesn't capture the market infrastructures and the real economy in this particular. Well, it does to some extent capture the real economy, but I don't have time to go into it. This just by means of a simple illustration of what we mean when we talk about systemic risk in practical ways, how we can track it. There's one way. There are many other ways you can try to have a coincident indicator of systemic stress. Now, how can we have a conceptual framework for systemic risk? So based on our work over the years in this area, I've used this. I developed for practical purposes this type of little heuristic tool. I call it the systemic risk cube because it's a cube, so it has 3 dimensions, and it distinguishes 3 forms of systemic events or systemic risks, which are different with respect to what the origin is. Is it idiosyncratic, the original of the problem? Is it idiosyncratic to start with or systematic already at the part, like system-wide? Is the trigger exogenous or endogenous, or is the impact simultaneous or sequential? I can't go through all elements of the cube. I don't have the time today. But you see the different forms of systemic risk indicated in different colors. I just explained to you briefly the 3 different forms of systemic risk. So the first form of systemic risk is contagion, which basically refers to a supposedly idiosyncratic problem spilling over in the cross-sectional dimension across intermediaries or across markets without the underlying problem being common to start with. Important distinction to the other dimensions of systemic risk. The second form of systemic risk I like to call the endogenous build-up and unraveling of widespread imbalances. Now this goes back to the old Minsky-Kintelberger type view of systemic risk. It tends to be neglected in the academic research community because it never has been formalized. But the current and past crises seem to teach us that it does play an enormous role and seems to be a historical feature of recurrent crisis. So we need to pay more attention to it. To this form of systemic risk. And the third form of systemic risk is simply that there can always be severe enough aggregate shocks, macroeconomic shocks, that can bring down a financial system and thereby create a financial crisis. So note that this type of categorization of systemic risk is different from the typical categorization distinguishing cross-sectional and intertemporal type of risk that is typically used these days or in policy institutions. It goes a bit beyond that. In our early work, we had the same categorization. We developed our framework in order to better capture the difference between aggregate shocks and the endogenous build-up and unraveling of widespread imbalances, which is important from a policy perspective. So we think that those of us who have worked on this type of conceptual framework actually think that these 3 forms of systemic risk are good guidance to what policymakers have to pay attention to. So if they think they want ex-ante prudential policies towards systemic risk, they have to reduce these 3 forms of transmissions that are possible to lead to a systemic event. Now, as was remarked before, so that was the problem, the definition of the problem and characterization and the framework of the problem. What is the answer? So I'm of the view that the broad policy response, and many people mentioned that this was actually more and more common sense, the broad answer is to strengthen the macro-prudential wing of supervision and regulation. Now, one remark to make at this point is that this type of macro-prudential aspect of supervision and regulation traditionally tended to be more hosted in central banks. Now, we have heard about, in the previous session, about the political economy of institutions, and I understand that there are difficult issues we can discuss in the discussion if you want, but it tends to be in terms of skills in different institutions and perspective on the problem of financial instability. It seems to be that the aggregate systemic view seems to be easier incorporated in the analysis of central banks that have already an aggregate macroeconomic view of the economy. Then in terms of the policies, the macro-prudential supervision would relate to the oversight that aims at identifying and containing systemic risks. So the objective is identifying and containing systemic risks of supervision, and the public regulations, the regulatory side, the policy instruments that aim at maintaining systemic stability. Now, this macro-prudential regulation is actually a fairly new policy area, although the concept of systemic risk was relatively well known, and also the supervisory aspects have been featuring high in speeches, for example, by policymakers from the Bank for International Settlements since at least a decade or so. The macro-prudential regulation as a policy area is actually a field that is developing. And if you think it to the end, if you use regulatory instruments to stabilize the financial system and thereby the aspects of financial instability that may lead to macroeconomic fluctuations, you can actually think of it at least in a theoretical way, as adding a third macroeconomic stabilization policy to the existing policies of monetary and fiscal policy. Now, whether in practice that will actually play that role is an issue that is open at this point, but it goes in this direction. The difference was already mentioned. Microprudential is focusing on the markets and in the intermediaries, and the distinction is really primarily by the objective between microprudential and macroprudential. Most known instruments, so far known instruments, are actually instruments that tend to be in the hands of microprudential supervisors and have been used for microprudential regulations in the past, but now have to be developed in a direction that we can use it from a macroprudential perspective, which distinguishes the two. This is one of the important distinctions between the two fields. Now, moving from the scope of macroprudential supervision now to the current regulatory reforms in Europe. Now, in this slide, I've tried to put in one slide, like, what is the current proposal for regulatory reform in Europe? So basically, this is a sketch of the legislative proposals that were done last year by the European Commission and is since then in the political discussion for introduction in Europe. This process is not finished. The European Parliament has just commented on the proposal, and now there is the so-called trialogue between the European Commission, the ECOFIN, and the European Parliament about finding a compromise for implementation of this. But the building blocks of elements that are displayed in this picture tend still to be broadly intact. So it looks as if something relatively along those lines is going to come in Europe. And I would like to show to you a little bit how that would work. So basically, there would be created two types of supervisory bodies. One, the upper one here in this picture, is called the European Systemic Risk Board, dealing with the macroprudential part of the policy, and the other being the European System of Financial Supervisors, which is the bottom part, dealing with the microprudential side of the policy. Starting from the bottom, the microprudential part will basically establish three European supervisory authorities, these three here, one for banking, one for insurance and pensions, and one for markets, which would incorporate underneath also the respective national supervisors. And the union of this would be the European System of Financial Supervisors, and the ambition is to strengthen the authority of the supervisory authorities that are on top of the national supervisors at the federal level. Now, this would deal with the microprudential regulation and monitoring, and would have also the task to convey the microprudential information to the macroprudential part of the regulatory architecture. More of interest to us today and to us in the ECB is the European Systemic Risk Board, since this board will be supported by the ECB in analytical terms, logistical and statistical and administrative terms. You should know that, however, this is not an ECB department or body. It is a body that will be supported through a secretariat located in the ECB, and it is composed of the 27 EU central bank governors, plus the 3 chairs of these 3 authorities, plus the European Commission, plus the ECB president, which likely it is expected to be the first chair of this committee. So it's a committee that will be meeting with heavy central bank involvement, but it will not be an ECB committee like we have other committees like for monetary policy, market operations, and so on. So referring to the presentation on the political economy and the issue of whether supervision should be in the central bank or not, so you have here a middle ground type of arrangement. You have a macro-prudential body that's close to the central bank, has all the expertise from the central banking side inside, but is not identical to the ECB. It's a committee meeting at the ECB, potentially chaired and supported by ECB staff, in dedicated units, like a separate secretariat, for example. So it sort of is a middle, if you want, middle of the road compromise between having supervision in the central bank, fully in the central bank, or having macro-prudential supervision outside the central bank. Of course, this body would have the task to convey the macro-prudential information, the systemic risk information to the micro-prudential supervisors, and cooperation between the two and exchange of information is of the essence. Now, more important maybe than the architecture is actually the tasks. So this body would have 2 tasks. 1, early risk warnings on emerging systemic risks. It's a lesson from the crisis that warnings have been there but were not allowed enough, visible enough, and clear enough. So this body would have a constitutional mandate to do these warnings. Second, policy recommendations. So it would have to recommend to the authorities that presently hold the regulatory instruments how to fight, how to answer to these systemic risks. It would, at this stage, if it's implemented like this, not have the instruments in its own hands. It would give recommendations to the competent authorities to use these instruments. Where would the warnings and the recommendations go? Well, they could go to different parties, the ECOFIN, the EU countries, different supervisory authorities. This is currently a debate where exactly these messages would be given. So this is in one slide the current proposal for the new supervisory setup in the EU. Now, how would this body do its job? Remember, warnings and policy recommendations. Let's start with the warnings. Now, obviously, there are 4 components of a sound systemic risk, and actually macro-prudential risk assessment is you need market intelligence, you need data and statistics, you need analytical tools and models, and you need the experience and judgment of the policymakers because of the complexity of the problem, and that not models and data will not show everything you need to know about. Let me just mention a few aspects under each which we have to pay attention to, which maybe have not been paid much attention in the past. So first of all, when I say market intelligence, why do we have to strengthen market intelligence? Well, for example, it turned out that in the supervisory community, the understanding of the role and risks of financial innovation was way too small. So market intelligence has to be strengthened, for example, to better understand the risks in certain financial innovations and understanding their systemic importance. This was not necessarily always understood as a core function of supervision as such, right? Data and statistics, I already mentioned the exchange of information. I am among the people that think a macro-prudential body needs to have detailed access to micro-prudential data, in particular exposures to cover the contagion risk of systemic risk. That requires detailed asset and liabilities and bilateral exposures of large and complex financial intermediaries. This is a complex topic, again, for the reason of that this data tend to be scattered over different public authorities. And the exchange of this information, as we also heard in the previous talk, is not uncomplicated. What about analytical models and tools? Following the conceptual framework that I've lined out at the start, you have contagion and spillover models, for example, counterfactual simulations, to assess contagion risks, using, for example, this type of data. For the buildup of widespread imbalances, you need an early warning system. We could discuss at length about how it could look. Obviously, the experience with early warning mechanisms is not too positive. Usually, it's very hard to forecast the next crisis. But the statutory tasks of that body, the European Systemic Risk Group, would have been to warn. So you have to come up with a system that and try to optimize it as good as you can. And the third, the aggregate shocks, is the macro stress testing models that we usually have start from macroeconomic scenarios, large but still plausible shocks as a starting point, and look what is the impact on the financial system. So this is like the basic ingredients to fulfill the first mandate. Now, I will not have the time to go through all the components of the second mandate task of the European Systemic Risk Board, which, remember, was the recommendations on policy. Here you have a list of different policy instruments organized along the framework that I'd like to use with contagion, imbalances, and aggregate shocks. So I will just give you a few examples and making a few remarks on emerging markets at that occasion. So contagion risk, I mean, this is not a comprehensive list of measures. So it's sort of, I try to put in 2 slides the most important instruments currently under discussion, but you can have many more, or you can weight them, order them differently. But say the first is how to counter contagion risk. So you have the enhancement of capital for counterparty exposures, the discussion on capital surcharges to have higher capital levels if you pose higher risks to the system, and levies for systemic risk, as we saw in the first presentation. You have the move of derivatives trading on central clearing counterparties, for example, as we also heard in the keynote speech from the president of the supervisory authority here in Korea. And you need to introduce procedures for orderly resolution and define living wills, like how procedures by an institution, how it would be resolved if it gets into difficulties. All these measures would help in reducing contagion risk if properly implemented. Most of them are currently at the international discussion for potential implementation. The widespread building up and unraveling of imbalances, we have the counter-cyclical capital requirements in the discussion. We have the forward-looking provisioning proposals already present in some countries, like Spain, for example. Then we have some of the elements that were already discussed today, like leverage limits, maturity, and currency limits. Currency limits may be more relevant for emerging market economies than for industrial economies. A balanced approach to accounting with respect to the availability of market prices and liquidity, so probably some limits on the overwhelming use of fair value accounting. We heard already about the compensation practices also. You have to make sure, remove incentives for risk-taking and herding behavior in compensation practices. And you have, for example, limits either on the demand or the supply of credit, either overall credit or credit to specific sectors like the mortgage sector. And here I want to briefly remark on the question of the policies in emerging markets. Now, for example, in the case of Korea, you have, since a number of years, a very active use, for example, of loan-to-value ratios or debt-to-income caps. And so the question is really, how should a macro-prudential policy look for an emerging market as opposed to an industrial country? Is it really different, and what can one say? One thing that I really want to say is that some emerging market countries have, with these instruments, much more experience than industrial countries have. So actually, some valuable information about the transmission mechanism from changing loan-to-value ratios, raising debt-to-income caps, and other things may actually be gained for industrial countries by looking at the experiences of countries like Korea or other countries of that type. So I think I want to reverse the question. I think, like, how can we make for industrial countries the limited experience we have with using these type of instruments? What can we learn from the emerging markets that have actually been forced to use them in crisis situations or in the emerging bubbles? Actually, it's a very actual question in Korea, I understand, at this very point in time, in terms of property developments, for example. They have been recently changed, these type of values, to counter property developments in certain regions of the country. I will not talk about the aggregate shocks. Let me jump over the instruments to limit the effects, to enhance the resilience against aggregate shocks. Let me just mention a few at the end challenges with this type of macro-prudential policies. They're quite significant. As I said at the start, it is a relatively new policy to use macro-prudential regulation as a policy tool. The transmission channels are not so well understood. It's very hard before you design a policy to have a good impact assessment, because little experience exists. Little models have all the ingredients you need to make a full impact assessment of the use of certain macro-prudential regulatory instruments. They're difficult to calibrate. In particular, if you look at the present situation, we have many regulatory proposals at the same time. So you have to look at, the relationship between bank levies to counter contagion risk versus enhancing capital accounts counterparty exposures. So you have to calibrate these instruments one with respect to each other. And given the limited knowledge about the transmission mechanism, it's quite a challenge to calibrate them properly. Important work is going on under the relevant committees around the BAS to actually do these calibrations at the present time. Very important role of and challenge for a macroprudential body. Remember the horizontal nature of macroprudential policy across all elements of the financial system. One big lesson of the crisis was great regulatory arbitrage between different sectors, different regulatory intensity and attention in different financial subsectors. So a macroprudential body that takes a fully horizontal view, collects all the information on all the subsectors, not implying that everybody has to be regulated, not implying necessarily hedge funds have to have severe regulations, but having the full picture on the system and being able to design policies to an extent that the arbitrage incentives are removed or diminished is a very important aspect of this type of policy. And finally, a challenge is it's really very difficult to assess the benefits and costs of these policies for the overall economy, given all the problems that I was mentioning before. And I think that I would conclude my presentation on macroprudential policy. Thank you.
Thank you very much.